Welcome, everyone. Thank you for joining us today. My name is Helen Morosomba. Thank you for joining Humentum's webinar, Introduction to U.S. Taxation for Inbound and Outbound Expatriates. And we are doing this with GRF, CPA, and advisors. And before I introduce today's speakers, I would like to thank our industry partners for their support and expertise. They help make Humentum's work possible. And second, I would like to inform you that we have upcoming events. We have some very interesting topics that will be covered in the month of October. Kindly register. I will drop a link in the chat. And also, just a polite reminder that we continue to have peer discussions in our roundtables. So make sure to register for that too. As you get settled, I will go over a few housekeeping notes just to let you know how things will run. All attendees are currently muted. To ask a question, please type in the chat box. You can access the chat box by clicking the chat bubble at the bottom of the screen. And then for we have subtitles available for this event. To turn on or off, please click on the live transcription on the Zoom toolbar, then show or hide based on your preference. Lastly, this webinar is being recorded. A recording and any additional materials will be shared in the follow-up email that you will receive later this week. If you do not get an email, kindly check your spam folder. And with that, I am very excited to introduce today's speakers. We have Jennifer Galstad-Lee, who is a senior tax manager, and we have Troy Turner, who is a partner and director for GRF CPA Advisors. Thank you very much for sharing your expertise with us today. Over to you. Thank you.
Great. Thank you, Helen. And thank you, everyone, for joining us this morning for our webinar on inbound and outbound taxation. So we just did the introductions. There we are again. So the topics we're going to cover today is who is subject to U.S. tax reporting, inbound and outbound. We're going to talk about common U.S. tax filing obligations for international taxpayers, and reporting challenges and best practices towards the end. And if we have time, we hope to answer some of your questions. So again, put those in the chat box and we'll try to get to a few of those at the end of the presentation. So Jennifer is going to start us off with the inbound tax topic. Take it away, Jennifer.
Well, good morning, everyone. Thank you for joining us today, and I appreciate the opportunity for this the presentation. And so before we begin to talk about the details of our tax code and this international taxation, I'd like to open up the discussion by talking about the basis of our U.S. tax code. So it is commonly known as citizenship-based taxation. That is what our U.S. taxation is. How it is designed. So basically, when the taxpayer is a U.S. citizen, it doesn't matter where that citizen lives or even works, or whether the income that the citizen earns it is actually U.S. sourced or sourced in foreign countries. That U.S. citizen is going to be subject to tax no matter where the physical location is or the income source is. And the other side of U.S. taxation, it's going to also reach out to foreign citizens based on certain things. Usually that's something that ties that foreign person into either U.S. source income, or somehow the tax residency kicks in to make that foreign person considered a U.S. person. So with that in mind, I'm going to go over who is actually considered a U.S. person for tax purposes. So U.S. person is either a U.S. citizen or a foreign citizen that is considered a U.S. resident alien. So it's just professionally, I don't really like the term alien, but that's how it's our current tax code is using to determine this particular group of taxpayers. So if it's a U.S. citizen, and that U.S. citizen's U.S. portion, no matter what. If it's a foreign citizen, then there are a couple things that we look at to determine whether that foreign citizen is a U.S. person for tax purposes or not. We already went over the tax code is very broad for U.S. taxation. And once someone is considered a U.S. person, that U.S. person is subject to the U.S. tax on worldwide income from all sources. So it is fairly important it's actually very important to make that initial determination whether someone is considered a U.S. person or a non-resident alien. So for a foreign person to be considered a U.S. person, there are two tests that we need to use to look into that determination. So the fourth test is called the green card test. So most of us are probably familiar with the green card is a colloquial term for lawful permanent residency in the U.S. So that's given by the USCIS. Now it used to be INS, but the name green card comes from the color green that the card used to carry, which is not the case anymore. We still call it green card. But anyway, if someone, a foreign citizen, is given a green card status under the U.S. immigration law, and given this green card issued during the tax year, that person is automatically considered a U.S. person. And so there's some of this the day counting or the residency start date set out here. So if someone, like let's say a British citizen, is given a green card status on December 30th of a tax year, and that British citizen was in the U.S. that day, then he's going to be considered a U.S. person for that tax year, and he's going to have to look at his worldwide income from all sources for U.S. tax reporting purposes. The second test is called the substantial presence test, and this test looks to this test looks to the number of U.S. days during the tax year plus the current tax year plus 2 preceding tax years. So the day counting is actually based on weighted U.S. days. So in this example, let's say if this person is a Finnish citizen and she stayed in the U.S. for 150 days this tax year. Let's say that is 2022, and then 180 days on the first preceding tax year and 30 days in the second preceding tax year. The weighted U.S. day total is 215 days. That is going to be the threshold 103 days or more. So that Finnish citizen is going to be a U.S. person. And then again, that the foreign citizen earned this based on the substantial presence threshold testing, going to have to look to for worldwide income from more sources for U.S. tax reporting purposes. And this day counting, the U.S. days is sometimes there's a lot of exceptions when you count these days. So for example, when a taxpayer couldn't leave the U.S. because of a medical condition, then that person can claim an exception to count those days into the U.S. days for substantial present tax purposes. For those exceptions, though, the taxpayer needs to make sure he files a special form. So there are the exceptions that are put on the slide. There are only some of them, and as you can see, certain visa statuses will give out that exception for day counting. So the bottom line to remember here is that there are exceptions, and in these rules. So it is very important to navigate this each taxpayer situation, not just the tax, the immigration, and everything else when it comes to international taxpayer to determine whether that person is considered a U.S. person or not. So in our practice at GRF, we commonly encounter certain reporting that were done wrong previously, and or sometimes the taxpayers overlook. And one of those things that we come across fairly often is a U.S. residency termination. So it's more often than not that there's a foreign citizen taxpayer who is considered a U.S. person based on either one of the two tests we already talked about. That taxpayer sometimes overlook that U.S. tax residency doesn't end automatically when the citizen goes back to their country, or certain situations like U.S. citizenship renunciation or a green card renunciation doesn't actually end the U.S. tax residency. So the general rule is that even if the foreign person who is U.S. person for tax purposes leaves before December 31st of that tax year, it doesn't automatically end on the day of departure. So it generally that the tax year ends on the last day of the tax year. So that this is, when you come to think of it, it's pretty significant because sometimes a foreign citizen goes back to her country and makes substantial income overseas, not realizing that the departure from the U.S. doesn't actually end automatically. The U.S. tax residency ending up subjecting that person to all sorts of reporting obligations for that person's foreign source income. So, I mean, there's a filing requirement that would require the foreign citizen to claim that U.S. tax residency ending before the year. It's just the oh, sorry about that. Something that we often see that is overlooked by the category of taxpayer. So it's important to review and make sure everything is in compliance. Another area of reporting error or something that people do not often realize that they need to be in compliance is the dual status here. So dual status is made up part when the residency status, also tax residency status, changes in the same year. So that means a U.S. taxpayer or foreign taxpayer tax residency changes from non-resident to resident, or from not resident to non-resident. So it often happens in the year of arrival in the U.S. or departure from the U.S. So part of the year, then when they're considered a non-resident alien for U.S. tax purposes, they don't have to report and even worry about the worldwide income from all sources. But the part of the year when they were considered a U.S. tax resident, they'll need to consider all income from all sources. So, so that it's pretty important to realize or determine that a certain year is a dual status year, because of that the implication where a single tax year will be divided into two different tax that appears non-resident and resident, and then subject either all income or only U.S. source income to U.S. taxation. So when a dual status taxpayer need to file a return, it's going to be either generally 1040 or 1040 NR. but currently, the IRS does not allow this dual status filing to be e-filed. So that actually adds another wrinkle for the taxpayers in this situation because they don't realize they can e-file. And there's also certain other statements that are required for this dual status return. So oftentimes in practice, we see the taxpayers don't realize there are certain restrictions they can claim on their dual status return. The one very common example is that they can't claim standard deduction in that dual status year. And that often ends in understated tax liability, especially for foreign foreign citizen who becomes the U.S. person in that same year, creating his status as dual status taxpayer. So there are other restrictions that are more often overlooked by both other practitioners and taxpayer. Altogether, there's no joint return allowed, and there's a certain tax credit not allowed. So I think the restrictions really don't end here, and that's pretty technical. But the important thing to remember is that year, the certain years for foreign citizens can be dual status, and it's very important to know that there are certain restrictions in place, and then there are also specific requirements that need to be filed for that dual status return. And here I want to talk a little bit about some other situations we encounter frequently. So when there's a foreign citizen or even U.S. citizen and with a non-U.S. citizen spouse, there are special things that we should consider for tax optimization. So for example, there's an election that can be made to file with a non-resident alien spouse, but that usually needs a very thorough analysis in determining whether that election to include a non-resident alien spouse in a tax return is beneficial or not. It's because the spouse nowadays, both spouses work, and sometimes the foreign citizen, non-U.S. Non-resident alien spouse can have substantial income overseas or substantial financial assets overseas. So if that's the case, that taxpayer doesn't necessarily want to have that all of those assets and income being subject to U.S. tax. So those things need to be considered in the overall analysis. And also one thing that I often encounter for a foreign citizen who becomes a U.S. person, when they come here with minor children, sometimes those minor children, even though they're legally present in the U.S., they can't obtain Social Security number for some reason. It's just has something to do with the immigration law. So they're legally here, but only for tax purposes. The taxpayer can only obtain ITIN for those children. And when that happens, that minor child is not going to be a qualifying child that is going to entitle the taxpayer for a lot of tax credits and deductions that are otherwise allowed for a qualifying child. So for example, I have some taxpayers that I help out every year. They have they bring the entire family with minor children, but they can't claim the child tax credit because of the number not being a valid Social Security number. So sometimes it makes a pretty significant difference because the dependent other dependent credit is only 500 versus as a qualifying child, that child can actually the taxpayer can claim the child tax credit up to like $3,600 per kid. So there's 6 times more credit than the other dependent tax credit. So those things are something that one must remember when you're dealing with this non-resident or the foreign citizen who becomes a U.S. person. And there's some areas in the taxation in their situation, it really are prone to errors, and as we see, it makes it difficult for sometimes for the person to amend or fix the errors after a few years. So the initial analysis and correct reporting is very important. So next part is tax reporting. So here we're going to talk about more technical side of the actual tax reporting, and Troy will cover this part, and I will chime in after the outbound taxation that he will cover on this side of the presentation.
Great, thank you, Jennifer. A lot of good information about tax reporting for non-residents as they come here and what they deal with. I know on the HR and admin side, you might not be dealing with a lot of those issues directly, but it's good to understand what your employees or contractors are facing when they come here and to do work for you. So it's important to understand all that and kind of the big picture. And so now we're going to move on to the Foreign Earned Income Exclusion, which is probably the biggest aspect of when a person moves overseas, so a U.S. citizen or U.S. resident, which is generally a green card holder, moves overseas for work, they can qualify for the Foreign Earned Income Exclusion. So obviously this impacts their return significantly and also impacts the reporting that's done by the organization for expat employees. So just want to cover kind of the ins and outs of the exclusion and how one qualifies and some examples. And then we'll move on to some other topics that affect outbound and inbound taxpayers. So first of all, the Foreign Earned Income Exclusion is only allowed for earned income, as it says. So it's wages or self-employment income generally. And there's a cap on that, and the caps for 2020 and 2021 are listed here. So for the 2021 year, it was 108,700, and that's per taxpayer. So both spouses, if they're both working overseas and qualify, can each get an exclusion up to that limit. And then the cap for 2022 is 112,000. So it's important also to point out that the exclusion is not available for employees of the U.S. government. But if the employee is working for a contractor of the U.S. government, so a private employer who gets government funding, then they can qualify as an employee of that government contractor, but not if they're a direct U.S. government or U.S. government agency employee. So we have the definition of a foreign country here. It's pretty straightforward. One of the major issues or criteria with qualifying for the Foreign Earned Income Exclusion is determining where the person's tax home is. So taxpayers' tax home is their regular or principal place of business or regular place of abode in a real and substantial sense. So in most cases, this is where the person is living and working on a regular basis. So in order to qualify for the Foreign Earned Income Exclusion, a person must meet 2 tests. The first one is the tax home test we just described. There's an example here of kind of an obscure reason why someone may not qualify for moving their tax home overseas if they're kind of on again, off again. But so the first part is the tax home test. So in order to move your tax home, you have to basically have moved your post of employment for a period of time that lasts for more than 1 year. So a year and a day. So I often advise clients if they're, writing some sort of a contract or agreement for an employee to move overseas, that rather than make it for a year exactly or 365 days, they add that extra day in there, because technically the person's, in order to qualify for the exclusion, they must actually have an assignment or be posted overseas, and actually follow that through for more than a year to move their tax home. And then the second part is to qualify either under the bona fide residence test or the physical presence test. So to qualify under the bona fide residence test, you must be a U.S. citizen or a green card holder. And if you're qualifying as under the green card provision, you must be from a country that has a U.S. tax treaty with the U.S. Otherwise, if that's not the case, then you can't use the bona fide residence test, and you must use the physical presence test. Bona fide residence test is a facts and circumstances test. So once you move your tax home overseas, there's two criteria, mechanical criteria you have to qualify or meet. And one of those is not to have made a statement of non-residence to the host country's government. And then the other one is to have been overseas for a full calendar year. And if you happen to have made a statement of non-residence to the government, but they still tax you like a resident of their country, then you can get around that statement piece. But generally, if those are the two mechanical pieces, and the rest of it's facts and circumstances. So you're looking at how long is the assignment, or family members moving overseas with you. Have you acclimated into the community? Do you have, have you bought a home, or are you renting, or is it employer provided housing? Again, is it indefinite or long-term, multiple year assignment? So you're basically looking at the entire picture. So just passing the mechanical parts isn't really enough. That's kind of just the gateway to that test. And then you have to look at everything else to see if someone qualifies as a bona fide resident. The main benefit of that test, they're using that test, is there's no day limit, which is present in the physical presence test. Under that test, you must be physically present in a foreign country or countries for at least 330 full days during the qualifying period that you want to use to claim the exclusion under that test. So that generally, limits your U.S. presence to 35 days if you're using the physical presence test, whereas the bona fide residence test does not have a day limit. Let's see. So we're going to go through a few examples here that kind of bring home some of these concepts related to bona fide residence and physical presence test. So in example one, we have Alice, who's a U.S. citizen who lives in Washington and agrees to go on an indefinite assignment here, and that's bolded and capitalized because we're making the assumption here that this indefinite assignment kind of meets all of those facts and circumstances to be considered a bona fide resident. She's moving to Portugal. She leaves November 1st to 2019. She travels back in 2020 for a month while her family stays in Lisbon. So under this example, she's met the 1 year calendar year requirement through 2020. So on January 1 of 21, she meets the basic requirements of moving her tax home and completing a full uninterrupted residency period of 2020 calendar year. So she can use the bona fide residence test, technically going back to November 1 of 2019 to get a partial exclusion there, and for all of 2020. And example two, if same as number one, except that Alice is unexpectedly transferred back on December 13th, 2020. So this precludes her from using the bona fide residence test because she wasn't overseas for a full calendar year. She was only gone from November 1, 19 through December 13 of 2020. But during that time frame, she still might be able to qualify for a partial exclusion in 19 and 20 using the physical presence test. In example three, we have John, who's a bona fide resident of Japan. So again, we're assuming he meets the kind of big picture fact pattern to be a bona fide resident. of Japan from March 1st of 18 through September 14th of 21. John returns on September 15th of 21. He was a bona fide resident of all of 19. And because we're saying he's met the criteria for the entire time frame overseas, he could get a partial exclusion as a bona fide resident from March 1st of 18 through the end of the year, and for a partial exclusion in 21 as well from January 1 through September 14. And again, during this time frame, we're not worried about the level of presence in the U.S. as far as meeting a specific or exceeding a specific threshold. Obviously, if someone comes back for 6 months or some long extended period of time, you'd want to kind of look at it more closely. But again, one of the main benefits of the bona fide residence test is not having that specific day limit. Under the physical presence test, on the first example here, we're kind of outlining how to count days. So we have Una who leaves California for Singapore on June 20th, 2020. She arrives in Singapore then at 8 a.m. on the 11th, so the next day. So her first full day in Singapore is the 12th. So the 10th and the 11th do not count as foreign days. For Una in this example, her first foreign day is the 12th, and she needs 330 of those full foreign days in order to meet the physical presence test. Excuse me. Under example 2, we have Daniel, whose tax home was in China from January 1st of 21 through August 31st of 22. Spends 28 days in February 21 in the US on vacation. So we're okay there. He's not exceeded the 35-day limit. So he meets the physical presence test for both 21 and 22. So he gets the full exclusion for 21 because he met the test from January 1st to December 31st. And we get a partial exclusion for 22, and he can turn the calendar back to grab some of those 21 days just to meet the 330-day requirement. So from September 1st to August 31st, you can get a partial exclusion in 22 by kind of rotating that calendar back and grabbing those foreign days from the prior year. So why does the qualifying period matter? We touched on this in some of the earlier examples, but if your qualifying period is for the full calendar year, then you get to take advantage of the full exclusion amount, which again is $112,000 for 2022, and it was $108,700 for 21. But if your qualifying period, like the last example where for 22, we had to go back and get some 21 days in September through the end of the year, and you're getting a prorated exclusion. So your exclusion isn't for the full amount. You only get a prorated amount based on the number of months during the foreign period. Another thing to point out is that when you have many expats, when they go overseas, because they're using the physical presence test and they've moved overseas during the year, they can't file until they meet the physical presence test. So that if they move overseas, July 1, and they're looking for the qualifier from July 1, say of 22 to June 30 of 23, then when they go to file their 22 tax return next year, they can't do so by April 15 because they haven't met the criteria at that time. So they'd have to file an extension in order to file their return until they met the criteria. So another thing to point out is expats who are overseas on April 15 do get an extra 2-month automatic extension at the federal level. Some states honor that, some don't. So you kind of have to watch whether or not the state still wants an extension on April 15th or not. Again, often even June 15th isn't enough depending on when the person moves, based on that qualifying period that they're looking to meet. And kind of an extreme example, I guess going back to the one where the person moved overseas on November 1st, if they're looking to get qualified under the bona fide residence test and they need to be overseas for the full calendar year, then you can file a special extension form 2350. And that carries you all the way through January 30th of the next year to file your tax return. So you can have the opportunity to meet the bona fide residence test requirement of being overseas for a full calendar year. So we don't run into that a whole lot, but that is available. So there's also a foreign earned income exclusion related to housing expenses. So there's a foreign housing exclusion or deduction. The deduction is for self-employed persons, operates in a similar way, but there's generally a housing exclusion, and you have to have qualified foreign housing expenses. So we have a table here that has a listing of common foreign housing expenses that one would look to qualify. So also lists some common ones that don't. So you got to be careful if you buy furniture or have domestic labor or just buying the property, or if it's excessive and extravagant, then there's extra costs for that, wouldn't qualify. But your general rent, utilities, repairs, insurance, if you have occupancy taxes, things like that, then those are qualified housing expenses for purposes of the foreign housing exclusion. So before I leave that, there is a cap on the housing exclusion. There's also a floor. So the government has as a general expectation that everyone's going to have some sort of housing costs. So they've created a floor that one must exceed before you get this additional benefit. The floor is roughly $16,000-ish. And then they also have kind of a standard cap that's roughly in the low 30,000s. So let's say the floor is 16 and the cap is 32 for a standard cost city. So if someone has foreign earned income, so their total, compensation package is above the 112,000, then they can get this additional exclusion if they have foreign housing expenses above the floor, so above the 16, up to the cap. And the IRS recognizes that not all jurisdictions are created equal when it comes to the level of housing costs that one could encounter. So there are higher cost locations where the cap is much higher than 32. I mean, I think in some places it exceeds 100,000 for the cap. So so that's a good additional benefit, because often our expats, when they move overseas, are maintaining a home back in the States. Now, often they'll rent it depending on how long they're gone to help cover some of those costs. But if they don't and they're carrying costs of two locations, then having this additional exclusion for the housing is a good benefit and very useful. And I think people really count on it. So I want to touch on the foreign tax credit here. So for those who have income that exceeds the exclusion, or maybe they're paying taxes in their host in the country that they're living in, and for whatever reason they had to come back 1 year for more than 35 days for work or personal reasons, so they can't qualify, for the exclusion, but they are paying taxes overseas. Then in order to alleviate double taxation, because again, as Jennifer mentioned, as a US person, citizen or green card holder, they're required to report their worldwide income on a US return. So they have the exclusion we just talked about to help, offset and be a benefit for our expats. But if they can't use the exclusion, or the exclusion doesn't cover all of their earned income and they're paying foreign tax, then they can use the credit to mitigate or completely avoid double taxation. So to qualify for that, it has to be a genuine income tax assessed by the foreign country. So, some countries have different types of taxes. So it has to be an income tax to qualify. It has to actually be a liability. So if they have the ability to file something and get a refund, and they don't do that, then technically they can't claim the credit for the taxes paid, because if they went through the process of filing and they actually could get the money back. So it has to be a real assessment. There's no credit for tax on excluded income. So if you can't double dip here, so if you have, 112,000 of foreign earned income and you're paying tax in the host country, and you use the exclusion, and it wipes out all of your U.S. tax on that income on your U.S. return, then you can't claim the credit. Obviously, there's no income left to claim or tax assessment on that income to claim the credit against. But if you happen to have some other type of income, or even claim it to carry it over, you have to basically reduce the taxes that relate to income that's been excluded, so that it end up not being reportable, or there's no actual benefit provided for those. But often, we see a lot of expats that have total compensation package well above the foreign earned income exclusion limit when you factor in housing and education and moving and everything else. So, often they're paying local taxes. So, taking the credit is an integral part of filing their return and making sure they're not being double taxed. So if you don't use all of your foreign taxes you're allowed to claim, then you can carry them back, the excess back 1 year or forward 10. You can claim the credit based on, cash basis, so actual payments during the year, or based on the accrual basis. And generally we make that determination for the taxpayers, whatever's best for them. Cash basis is easier, but sometimes accrual basis provides a better match to the income in payments. You have to follow certain protocols when you do your conversions, because obviously the taxes are usually paid in local currency. And the taxpayer can actually choose to deduct the taxes versus take a credit, but in most cases it makes more sense to take the credit versus the deduction. So a common additional filing we find for our expats, and also this applies to our non-resident folks who come here and become tax resident. So this would be for all U.S. tax resident payers, so non-residents coming here and meeting the green card or substantial presence test, or our U.S. citizens or green card holders overseas. But basically, all U.S. tax residents have to report their foreign financial assets to the U.S. Treasury on an annual basis. It's separate from their tax return, but in our case, our software, it's integrated in our software, so we handle this filing for most of our clients. It applies when a U.S. person has a financial interest or a signature authority over foreign financial accounts where the aggregate total at any point during the year exceeds $10,000. So not a very high threshold. So we see it certainly for our long-term expats. They're opening local accounts. The ones that are paying taxes locally generally have to have a local account to get the local currency paid into it. So they're generally subject to this. And then for our, kind of country directors that have signature authority over foreign accounts, even if they don't end up opening a personal account, end up having to file to report those organizational accounts they have signing authority over. So it's good to know that, if that's the case for your organization, that you need to provide this information to them so they can file their FBAR. The FBAR has a due date of April 15th with an extended due date of October 15th. There's no extension form to file. So generally, I just kind of view it as an October 15th deadline for the FBAR form, and we file it at the same time as we do our clients' tax returns. The FBAR has a 6-year audit period or statute of limitations. So if you have a situation where you have unfiled FBARs, the Treasury would expect you to go back and file up to 6 years worth of old FBARs, and if whatever reason your unreporting goes further than that, then you don't have to worry about years that are older than 6. So it's nice there's at least a cap on that, because of course we've run into circumstances where people have never filed for forever. One issue with the FBAR, there's no fee for filing it, and there's no tax assessment on it. It's strictly an informational return, but there's substantial penalties for not filing it. So the Normal non-willful failure to file the FBAR penalty is up to $10,000. And there's a current debate whether that's per return, so per FBAR filing, or per account. It's being litigated. So the IRS, of course, wants it per account, and the taxpayer wants it per, per form. But that's certainly is something that's looks like the Supreme Court might take this up. So we'll get some clarity there. And then if they can prove that you didn't file your FBAR and you knew you were supposed to, so you're a willful non-filer, then the penalty is actually up to $100,000 or 50% of the balance of the account. So if that spans over a couple of years, in theory, the IRS or Treasury could take all your money out of your foreign accounts. So it's pretty scary to be in that situation. So we generally don't deal with clients that would ever be in a willful situation. That would be something a tax attorney would handle. And there is a streamlined program for kind of catching up if you have no unreported income, where the IRS generally agrees not to assess any penalties. And then if in certain circumstances the penalty is capped at 5%. So there's a couple of programs where you can kind of catch up without any significant damage if you meet certain criteria. For the taxpayer themselves, when they're filing this, they must check a box on Schedule B that says they have a foreign account and that they're filing the FBAR, and they list the countries there. And then if the asset value exceeds a higher threshold, they have another form they file, 8938, with their personal return. We'll discuss that a little more later. Actually, here it is on the next slide. So the form 8938 is another form. So the FBAR goes to Treasury and is not technically part of your tax filing. The form 8938 goes with your tax return. So part of FATCA, which kicked in 2014, created this new form. There's overlap in that the same foreign financial accounts, bank accounts that you report on your FBAR would get reported on your 8938. The 8938 also picks up other foreign financial assets, so it's a little broader. If you held stocks directly in a foreign company that weren't in an account you were already reporting, you report those. Or if you had an interest in a foreign partnership, that would go on there. So there's some additional, foreign financial assets that end up on the 8938. The filing thresholds are in the chart below, so they're much higher than the FBAR. And they're very high for people who meet either the bona fide resident or physical presence tests, or for expats who are living and working overseas, a much higher threshold for reporting on the 8938 for them. But if they're US based, so for those foreign nationals who come here and tripped over tax residency and now are filing and have left some accounts back home, that threshold's fairly low. So I'm going to kick this slide back to Jennifer. She knows a little more about crypto and reporting than I do. So
this when the virtual currency has become getting more spotlight because of the IRS approach, and it really import a lot of increased reinforcement efforts towards the digital currency assets. This question has come up that whether this foreign or international tax reporting regime applies to virtual currency accounts. So just wanted to reiterate the fact that currently for FBAR reporting, we do not have that requirement because in their notice, most recent notice on the virtual currency account, they did expressly say that the virtual currency is not a reportable account. But in practice, we have seen taxpayers with the accounts that are sort of mixed in a mixed nature. So sometimes it can be like a mutual fund product that includes some crypto holdings, or their wallets actually have a combined holding with fiat currency and digital currency, some other financial assets in that one account. So so there are actually crypto managed funds that you can see in different brokerages, foreign-based brokerages, and in those cases, a taxpayer will need to review whether the FR reporting or FATCA reporting that is going to be part of a person's income tax reporting in the U.S. Does require all of the virtual currency holdings to be included. So I'm not sure if this side of virtual currency related financial assets, we still have some uncertainty, but it definitely needs some review and analysis with your tax advisor. So I'm going to just touch upon a little bit about the inbound taxpayer reporting for your tax purposes. So inbound in this case means that usually foreign citizen with business in the U.S. or investment or some other type of income sources sourced from the U.S. So general rule is that many of the types of income this foreign person will earn is going to be subject to 30% withholding. So it's really important to remember that this type of income or foreign person does require federal tax withholding at the income source. And there's also the law that requires withholding when a foreign person has an investment real estate property in the U.S. and ends up selling that property. It does require strict withholding upon the sale, so that needs to happen on closing. And there's when the foreign person has a business and that business in the U.S. is considered effectively connected income, then that the taxation on that income is going to be subject to a graduated rate, so that really the same tax rate that are applied to domestic taxpayers. But in this seminar, all of these things, that getting into details for all of these different tax regimes is a little bit beyond what we need to cover in this seminar. So it's important to remember that there are certain withholding requirements for foreign persons. And if that foreign person actually ends up having dual residency, and that's more of a tax treaty concept, that tax treaty, if there is a tax treaty, can actually differentiate any of these tax treatments that we talked about here today. So all of these require pretty thorough analysis given the taxpayer situation. So a little bit about that, that income that is subject to flat 30% rate of tax withholding. That would include interest, dividends, rent, royalties, compensation, services or wages for the foreign person. So I guess for the organization leader or the payroll department, they need to remember the withholding is the responsibility of the withholding agent, and sometimes the withholding agent is the payer, not the pay, or some other intermediary person. So the third person is sometimes it's pretty significant amount. So then again, there's when a foreign person is involved in a taxable transaction situation, it's important to go over international taxation triggered and associated with that transaction. And income sourcing rules on this slide, I just have some bare minimum basics for income sourcing rules. And again, it's a little beyond scope of today's discussion, and we will welcome your questions later on if you have any situation where this income sourcing rule becomes an issue in determining withholding obligation. This 1042 is actually probably a little bit more common when a foreign person is involved in the taxable transaction. So this is actually an equivalent of domestic tax form 1099. So it's either 1099 miscellaneous or 1099 net. And so one common example is that when there's a foreign person who is a contractor, independent contractor, that person should probably get a 1042-S. And often it triggers the 30% withholding. And so the requirement for filing is important to remember, and the extension request is available, but currently we do see a lot of tax applications that like over the counter ones. It doesn't really support these forms pretty well. So again, when you are in this situation, please review the tax transaction carefully with your tax advisor. So in the slide, we try to give you the very common tax reporting forms we regularly file for taxpayers in this situation, but some of the international tax reporting, it really they do require some forms that we don't normally see from domestic taxpayer situation. So again, when we have you have international taxpayer involved in your operations, it's important to discuss the transactions and the tax consequences in the beginning. So the non-compliance doesn't happen under the kind of thorough analysis. So with that, we're moving on to some of the common reporting challenges we see. So
Jennifer, just real quick to touch on.
when we have these taxpayers in this international taxation situation, they're more often their address changes, so that automatically actually puts into a difficulty of collecting something like even IRS notices or collecting tax refunds. I had some clients who specifically asked me, well, I'm leaving the US and we're not going to have an address here. How do we file and collect the refund? So those things are pretty common for these taxpayers. And then some other things that we commonly look at is the foreign person will be subject to, or even the U.S. citizen, who's the outbound U.S. citizen, they're going to be subject to foreign country taxation that is on a different tax year. So there are quite a few countries that are on a fiscal year that is not on a calendar year basis. So all of a sudden, these taxpayers will have to, they're tasked with gathering the tax data that come from different tax years and allocate and tell us the income and other tax deduction items. So that becomes sometimes pretty cumbersome. And also, this is actually quite common, the Social Security. It's not just US actually. So when someone has self-employed income overseas, that income is still subject to US Social Security, or often it's also subject to Social Security regime in that country. So triggers almost double tax situation where that person without further actions can subject to both Social Security system. So in the US, that's 15.3%, which is pretty high. So if there's a totalization agreement, then there's specific procedures and things that taxpayer need to do to claim the exclusion from one of the two countries. So he doesn't have to pay both Social Security taxes. And collection is another issue sometimes when a foreign person is a U.S. person for several years earning wages and other income that is subject to U.S. Social Security. Foreign person sometimes back to where the person came from, and for good, really. Sometimes like after retirement, and the collecting that Social Security benefit is sometimes it does put in some difficulty to claim and collect. And another issue that we frequently encounter is with foreign pension. So this happens very often when there's an employee overseas, and in that country, that employee would have some kind of tax favored pension scheme, and the employee pays into. Some countries actually mandate those things, like Korea mandate that, UK has a mandated employee pension system. So sometimes it happens automatically. And those things also will need to be considered for US tax purposes when that taxpayer is subject to US tax regime. And some other things that we could we often encounter is that the U.S. person, whereas the foreign person is considered a U.S. person. It's not just the federal income tax that taxpayer will have to worry about. Some countries don't have our tax system where we have both federal, state, and other local taxes. So those things actually bring in a little bit of surprises for some international taxpayers. And then so I put in the slide a little bit. The states have different rules. So and as rules continue to change, so it's important to go over those different rules for each taxpayer and determine the tax residency in both federal and state. And then and also sometimes when some taxpayers establish a state residency, it's sometimes really hard to break that residency. So for instance, I've had US expat client who is in one of the states in the domestically, and he left the country like 7 years ago, and the state actually tracked him down using the driver's license. So in that state, their tax department had a system to talk with the DMV and track down the taxpayer. So he got all these notices for the missed tax returns, and he ended up having to file. But so the important thing to remember is that when someone leaves the U.S. and was a U.S. person, so that taxpayer does need to look at both federal and state tax system and make sure he is in compliance. So I talked a little bit about certain difficulties we commonly see among international taxpayers, but Troy, would you like to chime in and share what you see in our practice?
Sure. Yeah, I guess just to touch on some of the stuff you've just covered in the last couple of sections, on the withholding on U.S. sourced income. So the first section of the presentation, we were Jennifer focused on non-residents who became residents here and all the reporting intricacies related to that. But when you have your non-residents who are here just for a brief period of time, and there's not really a tax residency issue, but they're going to be paid some sort of U.S. sourced income, then that's where the 1042 and the 1042S and the withholding requirements at 30%, kick in. And a lot with our clients, we see, there'll be, fellowship grants or scholarship grants, and, sometimes they can be tax-free, but, oftentimes they're not, they're taxable. And if there's even a special tax rate at 14% for qualifying scholarship and fellowship grants that are taxable. So just a couple other things to kind of point out there as far as seeing what I normally encounter with our clients when it comes to falling in the U.S. withholding on payments to foreign persons. It's usually for compensation, contractor payments, or in the scholarship fellowship grant area. So you just want to make sure you understand whether or not there's a treaty there that could exempt it or exempt a certain dollar amount of it before you make the payment, because if it is subject to tax, you need to withhold that up front, or maybe you'd be interested in paying it for them. But good to know ahead of time, so you can reach out and ask us, what the requirements are in making payments to, again, foreign persons who don't stay here a long time, or maybe they have one of the visas that exempts their presence, so they're non-resident the entire time they're here. So as far as complexities and other considerations on this slide, certainly whenever you're dealing with the international stuff, all the FBAR and the 8938 and the passive foreign investment, that's for our inbound folks to become tax resident and leave behind some foreign mutual fund investments. They get reported on that form and have special reporting regimes and some options there that make it a little less painful. On the pension side, Jennifer mentioned foreign pensions and that's a very complex area where foreign pensions aren't automatically treated in the same way as U.S. qualified retirement plans, because by default, they're not a qualified plan under U.S. eyes. So if you have a U.S. person with a foreign retirement account, there's a very good chance the U.S. isn't going to view it like a foreign retirement account, and it's going to view it in a different way. And it could be viewed like a regular old investment account, where they have to report, the annual income of the account on their tax return. So, but yeah, that's a very complex area, and it's very specific to how the foreign plan is set up. So, and definitely want to make sure that at the individual level, when they're reporting, that they're taking advantage of all the benefits that go along with being going on an international assignment, like the exclusion and credit that I mentioned earlier.
So I'd like to add a little bit about a foreign person, the inbound taxpayer, actually. So, in our practice, we've had clients who are really coming from this company, like the new company that is a new subsidiary of a foreign multinational company. And some of those foreign citizen taxpayers who later become a U.S. person for tax purposes, they're not very familiar with our system. So all of this tax reporting regime we have, it really catches them by surprise, because in many of those countries, their system allows them to really not have to worry about any of those reporting. So in the U.S., we report everything on one return, income tax return in general, and that is not the case in many other countries. When they take care of the withholding at source, that's the end of their tax reporting obligation. Here, they certainly have to collect all the tax data, showing all of those tax withholdings on all of their investment income or other income and have to reflect that on their U.S. tax reporting. So the cases where I usually have a more successful compliance experience is when the companies are more aware of these situations where not all foreign citizens are familiar with the U.S. tax system, so they more proactively help out these new foreign persons who come to the U.S. for their work assignment and whatnot, so that they're not behind on the U.S. tax compliance. So there's, as is see on the side, there's a little bit of planning is fairly important for this particular group of taxpayers. So for instance, before they move or before they completely immigrate into the U.S., they can plan on things like not just compensation, but maybe the number of days they'll spend in each country, so they can either avoid this friendly situation where they stayed here for not so long, but then all of their worldwide income had to be considered for U.S. tax purposes and reporting. And some other more practical things that we see for the international taxpayers is that they do need to consider their tax situation into their compensation package. So one example is tax equalization, so they don't have to pay more tax just because they work in a different location for the same company. And then the cost of living changes, so the moving expenses and other cost of differential costs need to be considered for their compensation. And for those who leave the U.S., as we already discussed a little bit before, leaving the U.S. doesn't automatically end their tax residency. So that's something that we do see quite commonly among international taxpayers. They sometimes they tend to think that their immigration status change, or only because it's legal, they think that it automatically translates to the U.S. tax filing status, and that is not necessarily true. So one will have to make sure their tax obligation, and if they leave the U.S. for good and are not going to return for any foreseeable future. And there are also a group of taxpayers who we see more often now. It's actually called accidental Americans. So these taxpayers are those who were maybe born here in the U.S. So by virtue of birth in the U.S., taxpayer is a U.S. citizen, and or sometimes the taxpayer was born and raised outside the U.S. and never even came to the U.S. in its entire life, still subject to U.S. taxation just because one of the parents is a U.S. citizen and that parent secured U.S. citizenship. So we do have those taxpayers, and generally when we have to catch up on multi-year back filing is when a person for some reason needs to come to the U.S. for work or school or some other reasons. There's an immigration proceeding needs to be overcome, and in that part of the legal proceeding, it requires a tax compliance. So then again, when the compliance is completely missed for many years, things are really hard to catch up and bring back to compliance. So I think the key thing to remember is really is when there's a situation involving international and that portion is subject to U.S. taxation, it really needs to be analyzed thoroughly with a tax advisor, and the situation, including the immigration like a visa status need to be considered in determining the correct filing status. So I think that is the end of our slide. And
So we have some
sure,
time here.
we have enough time to take questions, or if you have questions, maybe you can put in the chat box. We can check and see if we can answer.
Yeah, I see a few questions, but before we get to that, since we do have a few more minutes here, I wanted to kind of touch on the last slide, which was about pre-move, and one of the topics you covered earlier, which was about state issues. So for our U.S. citizen expats who move overseas for their long-term assignments, I often get questions a lot about whether or not they still need to file a U.S. state tax return. So whether they were living in Maryland, do they still need to, when they left, do they still need to file in Maryland while they're gone? And that seems to catch a lot of people by surprise. So most states consider their expat residents still tax resident in their state while they're living and working overseas. So they're still required to file there as a resident. I guess the good news is most states allow the same foreign earned income and housing exclusions. So most of them, comply with that and follow the same rules there. Some don't. There are a handful of states that don't have the exclusion. There are some states that will treat their domiciled residents as non-residents while they're gone, as long as they meet certain requirements. Some of them have like specific day limits, like 30 days, as long as they're not back in the state for 30 days during the year or things like that. But it can kind of runs the gamut of different criteria. But the main point is, when you send someone overseas to work long-term, that they generally would still need to file a return in their home state. So home state withholding is usually still required. If they're going to qualify for the exclusion, they can provide a Form 673. They can get out of withholding, income tax withholding, at the federal and state level on the excluded income. So that's an important thing to keep in mind. Also, understanding that they provided, their state of domicile to you in HR, so you know which state they're claiming as their home state. If they've always lived in one state and they leave the country and for 3-year assignment, and now they say they live in Texas, you may want to question that, or Florida, because those are obviously no income tax states, and it's not quite that easy to change one's domicile from one state to another when you're moving overseas. So there's, and again, different states have different criteria on how one changes their domicile. Some are more aggressive than others, but that whole topic is one that seems to come up quite a bit with our clients. What they need to do relative to state reporting when they have their expats overseas for a few-year assignment. So with that, it looks like we do have a few questions in the chat. Looks like the first one relates to visa status, H-1B or E-3 visa. So H-1B is a regular work visa. So people here on an H-1B would be subject to the substantial presence test requirements that Jennifer talked about in the first session, that 183-day U.S. presence test, basically, when you're looking at a 3-year period. So first off, their wages are taxable, and they're generally non-resident when they come here, and then they become resident based on when they meet the substantial presence test. So they could have all of the dual status filing requirements, and then have regular residency filing requirements depending on how long they're here on their H-1B. The E visa, off the top of my head, I don't recall exactly what an E is, but I don't believe that there's any special considerations for an E as far as being exempt from the substantial presence test. There are a few visas that Jennifer had on her slide earlier. An A visa, G visa, those are international and people who work for international organization or foreign governments. The F and the J, which are your students and your trainees, can be here for certain time limits and be exempt from substantial presence. So you're a student who's here to get a 4-year degree. They've never been here before, on an F visa before, would be exempt from the substantial presence tests for their 4 years they're here studying. So they'd be non-resident the entire time, and subject to those 1042S type reporting. If they got wages, then they would get a W-2, but basically they're just reporting U.S. sourced income, and treated as a non-resident under an F. I think there are some other ones, but those are the main ones we see the most: A, G, F, and J. Let's see. I think the next question relates to the F bar, signature authority over business or personal accounts. So you'd have to report both. So a personal account would be one that you have a financial interest in. So you're reporting that on your F bar, and your 8938 potentially. For business accounts where you aren't the owner, you have no financial interest, but just signature authority, you have to report those on your F bar as well. But those would not go on your 8938 because that's not an actual asset you own. You just have signature authority over it. Let's see, the next one here I see relates to defining U.S. sourced income. So I think we can back up. There was a slide that discussed. So here's the sourcing rules generally, for what's considered, like how you source different types of income. So dividends, so if it's a U.S. corporation paying a dividend, that's U.S. sourced income. If the payer of interest is a U.S. resident, then that's U.S. interest income. Rent's pretty clear when it comes to real estate. If the real estate's located in the U.S., that's U.S. sourced income, for rents that are generated by that property. Royalties is based on where that royalty is utilized, is where it's sourced. So if it's the royalty is utilized in the U.S. Trade or business, then it would be U.S. income. Sale of real property, so location of the property, if it's a U.S. piece of real estate and there's a gain on the sale, that gain is U.S. income. If it's foreign real estate and there's a sale, and that's a foreign gain. Personal property, this is not just like your car, but also would cover investments. So wherever the taxpayer's resident is where they would report the gain on the sale of their investments. And then the big one you'll see the most, I feel like, is in the salary, the wages and, contractor payments or scholarship or fellowship grant type things. Then that's sourced to the U.S. Is considered U.S. sourced income if the work is performed here for the wages, and or the consulting income or contractor income. And if the fellowship grant is, for studying basically in the U.S. So that's, U.S. sourced income. So that answers that question. So those are the only questions that I saw in the chat. We have, it looks like, just a couple more minutes if anyone wants to throw another one up there. Otherwise, I will turn it back over to Helen. And I thank everyone for attending our webinar this morning.
Thank you, Troy. It seems I don't think we have any other questions. But as I said earlier, this webinar is being recorded and we'll share it with you. You'll have it before the end of the week. I think with that, I would like to thank our presenters. Thank you very much. Also being part of our industry partners for sharing your expertise with us this morning. I'm sure everyone on the call is very appreciative of this. I think if that is it, as I said earlier, we have webinars and roundtables that are coming up. So make sure you can click on the link and see what we have in store for you. I think with that, we can end our webinar for today. Thank you very much for joining us and have a good rest of your day. Thank you.
Great. Thank you. Bye now.